Thanks for clicking. The Bank of Canada should look past shelter inflation when making its interest rate decisions. This according to a new report coming from TD Bank.
You.
Indeed, but TD is not the only one. In the aftermath of the StatsCan release showing that Canada's CPI had slowed to 2.9%, we saw a plethora of economists saying that since mortgage interest costs are doing the majority of the inflation causing, the Bank of Canada should cut rates to see inflation come down. But TD's report also gained widespread attention, with its own economist James Orlando taking to Bloomberg to answer some hard-hitting investigative questions. Yet, the Bank of Montreal's Robert Kavchuk and Doug Porter, well known for calling nonsense on the pandemic argument that supply and not free money was causing the real estate housing boom, noted that, as with anything, the future is not so simple, despite the simple arguments being offered. So what I want to do today is go over TD's argument that the Bank of Canada should look past shelter inflation, take a look at BMO's and the data's rebuttal, and then discuss some implications going forward. The Bank of Canada is set to make its interest rate announcement and subsequent press conference on March 6th of next week, and we'll obviously have an update out on that announcement and the press conference on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into TD's report. On to the report. TD's report argues that since the Bank of Canada has minimal ability to quickly cool shelter prices, the shelter inflation will continue to persist. And Bank of Canada Governor Tiff Macklem acknowledged this earlier in the month, noting that monetary policy can't solve the housing crisis. With Canada's vacancy rate hitting its lowest point since 1988 and rent prices soaring due to that fact, monetary policy can't change this structural demand.
Him. Not me.
And this structural demand, brought on in large part by high levels of immigration, has led to higher shelter inflation, with TD arguing that high shelter inflation is the single biggest factor in preventing the Bank of Canada from reaching its 2% inflation target, running at 6.2% year over year. Given that shelter inflation is beyond the Bank of Canada's control and is likely to persist regardless of what the Bank of Canada does, says TD, the bank should start looking past shelter inflation when making its interest rate decisions. So, since shelter inflation caused by high mortgage interest costs and high rent is going to be structurally higher over the next few years, then if the Bank of Canada includes that in its assessments, Canadians will suffer under the weight of higher interest rates.
I don't want to see you suffer.
On the other hand, if the Bank of Canada excludes mortgage interest costs from its calculations, ignores the cost of servicing that high debt brought on by lower interest rates, then we're in the all clear.
So our argument is that if you look past shelter inflation, inflation is very much under the Bank of Canada's control right now. Like we're very close. If you actually look at the Bank of Canada's previous preferred metric of inflation, we're at 2.4%. Okay, that is really close to target as we can get.
Well, no, it's not. The closest we could get would be 2%. It was sustainably below that number before the Bank of Canada printed you up a bunch of money during the pandemic. And B, the Bank of Canada doesn't measure inflation that way, and as we'll see, that's for a good reason.
Things are different now.
And here is the really interesting part. TD says that there is some precedent for the Bank of Canada ignoring mortgage interest cost, which it did prior to 2016, when it preferred to follow a different measure of inflation, CPIX, which excluded mortgage interest costs, before switching to measures of core inflation in late 2016. TD says that since the Bank of Canada said it was switching to measures of core inflation so as to not be overly reliant on transitory sector-specific developments, and that mortgage costs are now basically doing that, skewing the index higher, current measures of inflation are not accurately reflecting the overall Canadian economy. Now, let's take a look at this a little bit, as TD thinks it's being clever, using the Bank of Canada's own words against it, saying that because mortgage interest costs are skewing the index, a single sector is pushing up inflation. According to the Bank of Canada in 2016, we should be excluding it. First, let's take a quick look at this statement coming from the Bank of Canada, which TD didn't cite, so we'll have to go look for it. In fact, if we Google the statement upon which TD is relying, we only get a link to the TD article in question, as well as a Forex website, which also doesn't cite it. Forex can be excused for not citing their sources. TD is a bank, and the hope is that this research was conducted by somebody who would actually know better.
Not in this life.
But if we do a little bit more research, we can find that this citation comes from the Bank of Canada's renewal of the inflation target control in 2016. And in that document that TD didn't cite, and as we'll see, maybe didn't read, who knows?
High five.
The bank noted that it was getting rid of CPIX and focusing more on measures of core inflation, as it was concerned with volatility, focusing on measures that are not transitory. Deputy Governor of the Bank of Canada, Lawrence Shembry, doubled down on this notion in 2017, saying that the bank was looking for CPI measurements that are less volatile than inflation, that capture persistent moves in inflation, designed to filter out transitory components from the CPI, meaning short-lived deviations. Which makes sense. You don't want to make economy-impacting decisions based off a single metric, like food or energy, which could swing wildly from one month to the next. So, when the bank wrote that document that was referenced but not cited by TD, when the bank opted to switch from CPIX to measures of core inflation, it was doing so out of a concern for volatility, seeking to avoid the inclusion of transitory forces, which would dissipate within a year. Is shelter inflation in Canada transitory? Or, as Shembry spoke of, is it persistent? Well, by TD's own words, shelter inflation in Canada is structural, meaning it will continue. It's not temporary. It's not volatile. It's not transitory.
How's that for clever with words?
And I think it's worth remembering that TD didn't mind so much including shelter costs in the inflationary measurements back in 2021, back when home prices were rising and mortgage interest costs were pulling down inflation. No mention in that document whatsoever about excluding mortgage interest costs to get the true picture of inflation back in 2021. In fact, very few mention this metric in the 2 years prior to the rate hikes, especially compared to the plethora of mentions we see in 2023. Even though, as early as February of 2021, we knew that if we had removed mortgage interest costs, which were being artificially pushed down by the Bank of Canada's money printing, we would have seen that inflation was actually 1% higher than that which was being reported. But, as we all know, 2021 was a very different time from 2024. So, in summary, TD says that the Bank of Canada is relying on measures of inflation that include mortgage interest costs, which it didn't used to, and those measures are heavily skewing the data, not reflecting their overall economy, and as such, the Bank of Canada can look past those shelter costs when deciding on interest rates. But, says Robert Kapchik of the Bank of Montreal and Basic Ability to Recall History, if the bank cuts too soon, house prices will increase, which will also derail inflation. And yeah, we all know that. We all saw that last year, when Canada's benchmark price rose 6.4% in 6 months, just on the Bank of Canada saying it was going to pause on rates, let alone cutting. And we also know it from the pandemic, back when interest rates were zero, and house prices pushed up shelter costs to their highest rate of increase since 1990. Looking at this chart, we can see that shelter prices actually rose at their fastest pace during the pandemic, when interest rates were low, not when they were high, due in massive part to the increase in house prices. And Kapchik went on in the article, noting that you'll get some relief on mortgage interest costs, but at the expense of higher house prices. And yeah, again, we all know this. We're getting shelter inflation one way or the other. It's either A, through mortgage interest costs, which has the side effect of pushing down asset prices.
Hadn't noticed.
Yeah. Or we're getting lower mortgage interest costs, but higher house price inflation, which has the side effect of pushing up the value of everything else, including TD's assets.
Hadn't noticed.
And Doug Porter, also of the Bank of Montreal, also doubled down on these comments, noting that home prices, which are reflected in homeowners' replacement costs and other owned accommodation costs, have double the weight of mortgage interest costs. Meaning, even if we exclude mortgage interest costs from the inflation calculation, as TD is arguing, when house prices go up, and previous experience says that they will, inflation goes up anyway, along with everything else. There seems to be this idea coming from the banks, coming from the real estate industry, coming from you-know-who, that we don't know exactly what's going to happen when the Bank of Canada cuts rates. Kind of like some acted like they didn't know what was going to happen when the Bank of Canada printed money and nobody was working.
Well, there's no way to determine that, Sam.
Yes, there is, an infallible way.
And the persistent pushing of this narrative that the Bank of Canada just ignore the factor that is doing the majority of the inflation causing is getting a little ridiculous, as the pattern is clearly on the wall. If the Bank of Canada lower rates, it will look momentarily like inflation is getting better, and then we'll get higher house prices, after which the Bank of Canada may have to raise rates again, but those will be higher rates on higher prices, kind of like we're seeing now. Pundits will say that those higher rates are doing the majority of the inflationary causing, and then we'll have to see rate cuts, and on and on and on it goes, until it doesn't.
Sign me up.
And make no mistake, the Bank of Canada very well knows this. When gas prices went sky high in the 1970s and the 1980s, the Bank of Canada didn't just ignore those gas prices, even though they were doing the large majority of the inflation causing, and lower rates anyway.
They were wrong.
If the bank does decide to lower rates, I don't think it's because they're going to be ignoring shelter inflation. They're going to be doing it due to concerns over the economy. They're going to be doing it despite potential shelter inflation. With that said, we will continue to track the Bank of Canada, especially at next week's press conference on March 6th on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.